Hello and welcome to the UBP podcast. My name is Peter Kinsella and I'm the Global Head of Foreign Exchange Strategy here at UBP. In today's podcast, we're going to be looking at the outlook for Eurodollar. Since March, Eurodollar has risen from levels of around 107 to current levels of around 117. The initial decline to 107 reflected the dollar funding squeeze, as corporates and financial companies were forced to enter the spot market to acquire dollars as their normal funding sources had dried up. The Fed subsequently opened a number of FX swap lines with advanced and emerging market central banks, which calmed markets and led to a reduction in dollar demand. Most of the recent Eurodollar up move reflects dollar weakness rather than euro appreciation. The US dollar index has now weakened by around 8% since mid-March, but trade-weighted euro exchange rates have only risen by around 2% during the same period. Investors were quick to position themselves for further dollar weakness. The latest IMM net non-commercial futures data show that investors have steadily increased their long euro positions since March. We believe that fast money and hedge funds have quickly established long euro positions, but larger institutional investors have not been as quick to get into the trade. So although net long euro positions are at levels which were last seen in 2018, there is scope for further positioning increases. In May and June, US economic data rebounded strongly. US NFP data were much better than expected, and the US ISM index printed robustly. However, these data are backward-looking. The development of the COVID-19 pandemic in the Sun Belt states implies that current and future economic data releases will be less than stellar. Indeed, the latest initial jobless claims data showed that the labour market recovery has run out of steam. The slowdown in US economic activity has two implications. First, slowing activity implies that the US will not experience a V-shaped recovery, or indeed anything like it. Second, the slowdown means that there is an increasing chance of Fed forward guidance changes or easing measure announcements at its August or September meeting. Because European countries have managed to contain the spread of the COVID-19 pandemic in a more effective manner, it implies that lockdown measures can be sequentially eased over the coming weeks and months. The corollary of this is that Eurozone economic data will likely continue to surprise to the upside of expectations, and this bodes well for the euro. The bottom line is that cyclical developments will weigh on the dollar in the coming weeks and months. Coming into the fourth quarter, we believe that there is a risk that the Fed may announce or give more details on a potential yield curve control policy. The announcement effect will weigh on the dollar. If and when this manifests itself, investors will finally realize that the dollar has lost a permanent interest rate advantage because yield curve control policies preclude any normalization of monetary policy, i.e. higher interest rates. Ultra-long end interest rates in the 30-year sector could flatten aggressively on this, meaning that the dollar would have lost its rate advantage across the entire US term structure. There are also rising event risks for the dollar over the coming months. Because US President Donald Trump is faring badly in the polls, we think this increases the chances of unexpected foreign policy endeavours. We expect that US-China tensions will remain elevated coming into the November election. We believe that markets have not sufficiently priced in the full implications of a Biden presidency. If Trump was good for equities and the dollar, then Biden is likely to be less benign for both asset classes. First, Biden is likely to raise corporate taxes, and this may have a detrimental impact on US equities, temporarily at least. Second, the dollar will not benefit from substantial capital inflows under a Biden presidency as it did under Trump. We think that the dollar can easily decline by around 5% on a trade-weighted basis over the coming months if markets begin to price in the possibility of a Biden presidency. The upshot of all this is that there are increasing risks of dollar weakness due to the combination of further Fed easing and US domestic political developments. Also in July, the European Union finally agreed on a plan to tackle COVID-19 related outlays via a €750 billion fund. The main elements of the fund include a grant package of around €390 billion to be distributed to member states in line with economic damage caused by the COVID-19 pandemic. The remainder of the fund is to be distributed in the form of low interest rate loans with only modest conditionality attached. For the first time, the fund is to be funded by common debt issuance. This is the first time that the EU has commonly issued bonds to pay for grants, i.e. non-repayable monies. Previously, the EFSF and the ESM raised monies for low interest rate loans. The new funding mechanism has a number of implications. First, it has reduced the tail risk of a peripheral debt crisis because debt to GDP ratios will not be as elevated as previously assumed. Because the European Central Bank will continue to purchase peripheral bonds, this means that borrowing costs will remain at very low levels over the coming 2 years. Second, the Recovery Fund will create a genuine European sovereign curve with reference pricing for all other euro-denominated assets. This is an important development because it may substantially decrease peripheral funding costs. Third, the Recovery Fund creates the possibility of an improving cyclical story for the euro and for euro-denominated assets. However, we don't think that the fund is a total game changer. The fund is an EU-wide entity and is not focused solely on the eurozone, and this is an important point. Also, the core European countries believe that it is a one-off due to the particular circumstances posed by the COVID-19 pandemic. We do not believe that voters in core member states will support continued transfer payments to southern countries over the longer term. It's clear that the EU's Recovery Fund has prevented risks of a peripheral debt crisis from manifesting itself in the short to medium term. The Recovery Fund will set up the euro for an improving cyclical story and will also benefit from ongoing dollar weakness. Regular listeners of our research will know that we believe the euro traded at low valuations in both nominal and real terms. The recent euro-dollar upmove means that the euro is more expensive than before, but it was coming from a low level. Most of the euro-dollar upmove reflects dollar depreciation or dollar weakness rather than euro appreciation. Consequently, we do not believe that the recent upmove will prevent further euro appreciation. Indeed, the dollar is still at elevated valuation levels from a historical perspective. And as we've noted before, the dollar tends to weaken during global economic recoveries, and this time should not be any different. Our estimates for euro-dollar fair value are between 125 and 130. The ECB does not want to see aggressive euro appreciation. Indeed, the ECB will be concerned about the pace of the upmove rather than the level itself, meaning that we should expect to hear ECB officials trying to talk down the euro if euro-dollar reaches levels of around 120 in a short space of time. Investors should of course note that this is just talk. The ECB has not done anything regarding external European valuations, and it is unlikely to do so anytime soon. The only caveat we have regarding short-term prospects for euro-dollar is the level of investor positioning. Fast money investors have already established long euro-dollar positions, and as noted previously, the latest IMM data show that net long euro positions are at elevated levels, which last manifested themselves when euro-dollar traded at levels of around 122 in early 2018. The EU Recovery Fund announcement means that European politics can finally move on to more pressing topics, and high on the list will be relations with the US, which have deteriorated significantly in recent years. A Biden presidency will reduce the chances of an EU-US trade war, and that's a benign development for the euro. The EU is unlikely to press ahead with its digital tax plans until after the US presidential election. And what that means is that the euro is kind of in a sweet spot for the coming months, because there will not be significant blow-ups with the current US administration. Because the dollar is the world's foremost reserve and transaction currency, when it appreciates or depreciates, it has significant implications for advanced and emerging market currencies. What matters is not just whether the dollar depreciates or appreciates, but how it does so. In a sense, there are different shades of dollar appreciation and dollar depreciation. Since March, the dollar has gradually weakened on a trade-weighted basis. In particular, currencies with a high beta to global growth have outperformed. This is consistent with previous periods of global economic recovery, when the dollar weakened modestly and risky assets in general outperformed. Notably, cross-asset correlations have increased significantly since March, indicating that dollar weakness was a function of the Fed's easing policies. We think that the phase of risk-on dollar weakness will plateau over the coming months ahead of the November US presidential election. Consequently, we think that safe haven currencies will now illustrate greater appreciation against the dollar than high beta pro-growth currencies. The likes of gold and the Swiss franc have already moved substantially, though we think there is definitely more upside potential for the Swiss franc, particularly if risky assets underperform. Dollar yen has also declined, mainly reflecting dollar weakness rather than yen appreciation. We believe that idiosyncratic yen appreciation potential will be limited because of the decline that we anticipate in the Japanese current account surplus. The euro trades as kind of a quasi-safe haven stroke a high beta currency, reflecting the eurozone's current account surplus and large trade surplus with the rest of the world. Because the tail risk of a peripheral debt crisis is now low, we think that the euro will outperform as investors reassess the eurozone's economic fortunes in the months and years ahead. In summary, we conclude that Eurodollar will continue to appreciate towards its fair value between 125 and 130. Thanks for listening.